Good morning again, everybody. We welcome you to the 2024 Stark Community Foundation Investment Webinar. And I'm Carrie Bass, the CFO of Stark Community Foundation. We're going to mix it up a little bit this time for the 2024 webinar. We're going to provide our typical investment update, talk a little bit about performance, but we're going to take advantage of the opportunity with this being an election year to also dive in a little bit of the impact of the presidential politics on the market and the economy. So it should make for an interesting presentation. It's hard to believe we're a week away from the election, so the timing probably couldn't be better to discuss some of this. As usual, it'll be my pleasure to introduce both Chris Caparelli and Evan Frazier from Marquette Associates. We've been partnering with Marquette as our investment consultant since 2019 now. If I could give you just a few housekeeping items before we get started. Everybody's audio and video has been turned off by default. If you do have a question, we ask that you put it in the Q&A feature, and we'll do our best to manage those, and we'll get to those at the end as time permits. Again, please use the Q&A feature for any questions you might have. Other than that, I think we're ready to go. So I thank all of you for joining us today, and most importantly, thank you for your partnership with Stark Community Foundation. So with that, Chris and Evan, as well, we thank you for being here today, and we're going to turn it over to you to share your expertise with us here this morning. So thank you.
All right. Well, thanks, Carrie. Callie, thank you as well. Thanks for having us. It's a pleasure to speak with you all this morning and steal a little bit of your time on, I'm sure, what's a busy Tuesday morning. So just real quick, Chris Caparelli and Evan Frazier from Marquette Associates in Chicago. Being in Chicago, we are probably not quite as sick of the election as you all are in Ohio, being a little bit more of a battleground state. So you probably get a few more political ads than we do here. But I'm sure we're all probably looking forward to getting on to next week and moving forward. So with that, just wanted to give you kind of a brief update of kind of who we are at Marquette, what we do for the Community Foundation, and share some of the work we've done over the last number of years. And then I'll give a quick sort of intro on markets, just at a high level. And then we'll pass it over to Evan to talk a little bit more about how we see the political landscape and perhaps how that might shape financial markets over the coming months and quarters. So I'm a field consultant at Marquette. I spend all my time out working within organizations like the Stark Community Foundation. Evan is on our research team. Evan spends a lot of time with alternative asset managers and just general capital market research. And a little bit about Marquette. We've been working with the Community Foundation for a pretty good number of years here, certainly extended pre-COVID, and that whole COVID timeframe gets a little time warped, but it's been a good track record. And really all we do is working with institutional investors. So we work across a couple of different underlying client channels. The nonprofit segment is our largest and kind of fastest growing. And as we think about some of the nonprofit clients we work with, we're really fortunate to work with a number of really phenomenal organizations, primarily around the Midwest, but a little bit around the country as well. I think one of the things we're the most proud of is our client tenure. Most of our clients at Marquette have been with us for a decade or more. That's sort of our average timeline. And it's really great to be able to see organizations transform over the time frame of a decade or longer, to see strong capital market performance translate into higher portfolio values, and then higher portfolio values translate into allowing places like the Community Foundation to do more and more good work in the community and continue to sort of reinvest inside of Stark County. Marquette's an independent consultant. Why that we think that's important is that we've got no conflicts of interest and no sort of ulterior motives as we think about recommending investments to the investment review committee that ultimately make it through into the portfolio. And why that's important is it allows us to keep our missions aligned. Our goal is to allow our clients to be good investment stewards, and the Community Foundation is to, again, sort of continue to do good work in the community and grow the dollars and be able to put them more and more back to work into all the causes that are so important. And if we just sort of think about, a few things we do at Marquette, we've been fortunate enough to work with Stark for some time now. The staff is a phenomenal group of people that we work with. The investment review committee is a great group. Overall, the organization's in great hands. And as we think about sort of that partnership that we've developed over the years, our first kind of goal is to build an investment program, but there's a lot that goes into that: macroeconomic research, things like asset allocation, manager search, and all sort of the various functions that we perform on an ongoing basis to sort of build that portfolio, maintain it, and hopefully continue to drive really strong outcomes as markets kind of move around us. So that's just a little bit on Marquette. I will spend the next couple minutes talking through the markets, and I'll start on this chart here, which, as you notice at a very quick level, everything is pretty far to the right of the y-axis, which will tell you at a high level on a quarter and on a year-to-date basis, and this data is through the end of September, it has been a pretty good year for capital markets really across the board. We can think of only just a couple exceptions here in 2024. If we think about the thing that's probably gets the most attention, I was walking through the kitchen this morning. We got CNBC on the television. We've usually got the S&P 500 front and center. That's the U.S. large cap stock market, the one that we spend so much time and attention thinking about. That's had another really good year here in 2024, up 22.1%. That's the top bar. And then as you go down the list, most other areas of the capital markets have not quite kept up with large cap U.S. equities. That's been a great asset class this year and has been for the last number of years. But a lot of things have done really well also. So if we think about things like small cap stocks a little further down the page at the Russell 2000, that's up 10% this year. Non-U.S. equities, so stocks outside of the U.S. in developed market economies like Europe and developed Asia, measured by the EFA index, up 13%. And then even the bond market, which has had a fair amount of turmoil over the last number of years, given the much higher interest rate environment we have today than we did a few years ago, even the bond market's had a pretty good year here in 2024. Probably the sort of lowest return expectation asset class in the portfolio, up about 4.5%, and that's investment grade U.S. fixed income. So been a pretty good year here in 2024, and certainly pleased with the results sort of across the board from most corners of the capital markets. As we zoom out a little bit, and there's a lot of colors and a lot of boxes on this chart, it's just our kind of periodic table of returns that looks at sort of all of those asset classes on a backdated basis, both calendar year, and then on the right-hand side, you have sort of annualized average numbers. So the first thing you'll note is the year-to-date column is the one we just reviewed. Been a good year here in 2024. A lot of that was true in 2023. So back to 2023, we had large cap equities up 26%. So it was 26% in 23, 22% so far in 24. That's a pretty significant rally over the last kind of 12 to 24 months that has really changed the sort of return environment compared to where things were in 2022. If you sort of look down this 22 column, we don't have to go that far back into our sort of collective history to find a time when things weren't so great across the capital markets. 2022 was a tougher year for sure. That was the year when the Fed was dramatically raising interest rates to combat inflation. And as a result, assets really across the board had a pretty tough go, sort of reevaluating and repricing themselves in this new higher interest rate environment. Going from 0 to 5% in a pretty short period of time causes a lot of stress. And thankfully, we've had some time now since that point in time and been able to put quite a bit of distance from sort of the today environment from where we were a couple years ago when things were not so great. The other thing I'll point out on this chart, so we've got the calendar year returns, but if you look in the upper right-hand corner, that's the 10-year sort of collective experience over the last decade. And even though a lot has gone on over the last 10 years, we had the COVID environment, there's been plenty of geopolitical events. It's been a pretty good decade over that last sort of 10-year period. If we think back to 2014, over that time frame, stocks in the U.S., again, large cap equities leading the way at 13% per year, which is a pretty significant return, and certainly points to the fact that most portfolios and a lot of client portfolios that we oversee have experienced some really nice growth over that 10-year period, with some significant return really across the board. So thinking about just a couple of the macroeconomic factors that really influence the return environment that we're in. Inflation has been a big one over the last couple of years. It's probably not quite as top of mind for sort of market participants today as it was a couple of years ago. And the reason for it is that you can see pretty clearly on the chart here, inflation has come down. So we no longer have that inflationary environment from a couple of summers ago where, price increases were 6, 7, 8% sort of year over year. That pace of increase has slowed. Today, it's closer to maybe 2.5 or 3%, whichever measure you look at. And I think there's really two important things to think about here. One, the Fed is targeting 2%. That's their long-term inflation goal for the U.S. economy. And the first thing you'll see on the chart is here, the current readings in inflation are not all the way back to that 2% level. So while it seems like the Fed is certainly sort of done maybe fighting inflation, there's probably a little bit of a ways to go for them to be completely comfortable and have inflation back to 2%. And then 2%, as we talk about inflation being back under control, that's just the pace of new price increases. The stuff on the left kind of side of the chart, the 6, 7, 8% year over year price increases, that's baked in. And that's likely not going back to the way it was. We rarely see the opposite. And I think that's why this has become such a big issue, certainly on the political front, as we think about what's coming up next week for both parties, because this causes real issues for Americans all across the board. When you go to the grocery store and see price increases, and when you go just to go buy insurance, there's so many different asset categories that just make their way into kind of our lives as everyday Americans. The prices increased in a pretty dramatic way over the last couple of years. So this is something that is certainly top of mind and top of focus on the political front. And while us sort of on the market side is easy to say, hey, inflation's back under control, the price increases that have happened over the last couple of years are baked in, and again, probably not going to reverse themselves. So it's a very different environment today than where we were a couple of years ago when inflation was very flat and not really causing the same type of stress. What's happened over the summer is that the Fed has sort of been clear and has communicated that they now see sort of two sides to risks in the U.S. Prior to really June, there was not a whole lot of talk around the economy about slower growth or a recession. The concern really was all inflation. And in our central bank here in the U.S., they have a dual mandate. Their mandate is to keep prices stable and to keep Americans working to the extent that they can and keep unemployment under control. So again, prior to kind of the middle of the summer, the unemployment market was not much of a concern. And then all of a sudden, sort of the last couple job market releases that we got in July and August, we started to see a little weakness sort of creep into those jobs numbers. Not quite as strong as what you'd seen maybe a year ago, and unemployment has moved up a little bit. Now, it hasn't moved up dramatically. I think the low we got to was about 3.8% unemployment, and it reached about 4.3. It has since come down a little bit. 4.1 is still a really good reading, and it would say that, hey, that's pretty close to full employment in the U.S., but it's not necessarily the level of unemployment that is so important, but it's the trajectory. And I think, the Fed was pretty clear at a couple of their last meetings that they're now starting to be a little bit more worried about, and they don't want to see that 3.8% go to 4, 4.5, and 5 and sort of ramp up into something much worse. So they've been pretty clear that they now see really two risks and need to sort of fulfill kind of both sides of their mandate. And that really impacts the interest rate environment and how we think about sort of portfolios around it. So moving to the sort of ever important interest rate slide, the green line is what the Fed funds rate has looked like over the last few years on the left-hand side of the chart. And then the right-hand side of the chart in that kind of gray box is what the market is expecting that Fed funds rate to be going forward. So this is short-term, overnight sort of cash deposit. And you can see, back in early 2022, rates were zero, and they had been that way really for a decade, kind of going back to the post Great Financial Crisis timeframe in 2008. Interest rates were increased rapidly throughout 2022 and into 2023. They've stayed pretty steady for some time over the last kind of 12 months or so. And then just in September, the Fed put through their first interest rate cut. So it was sort of a change in the direction of policy. The cut was probably a little bit bigger than most were expecting. They cut interest rates by 0.5%. It's a little bit more normal to see them move in quarter percent increments. So 0.5% was a little bit dramatic. And I think it was just, again, a realization from them that we're no longer just fighting inflation. We now have to think about the overall economy and unemployment. And with unemployment moving up, they thought it was the appropriate time to start loosening monetary policy a little bit. As you look to the kind of right-hand side of that chart, that dotted line sort of flattens out around that 3% range, sometime in the next couple of years. So, we should expect the forward trajectory of interest rates to be down. The question always is, well, what's the timing of it, and how how dramatic is it? And I think that the Fed would still say, hey, that the interest rate level we have today is probably restrictive at 4.75%. Somewhere closer to 3% is probably where we should be on sort of that neutral rate of interest. So that's sort of the expectation going forward. And the interest rate environment is linked to so many other things as we think about overall portfolio construction. So this is certainly a really important factor as we think about building and maintaining portfolios. If we take kind of a further step back and look at sort of the overall economy and a couple metrics, you've got the Fed funds rate likely coming down. You have GDP growing at a relatively steady rate. Unemployment, even though it's maybe moving up a little bit, is still kind of near historic lows. And then inflation has come down. So we've seen this term sort of thrown out a little bit over the last couple of months and quarters that we're sort of in this Goldilocks environment. And certainly when we look at kind of the market and economy related factors, everything looks pretty good. There's always some pockets of weakness and areas of complaint, but at a high level and sort of across the country and across a lot of different sectors, things look pretty good. This is translated into pretty decent corporate earnings. And as a result, the stock market has done relatively well. The one thing that's not on this chart and the one thing that is really difficult for markets to price is what Evan will talk about a little bit, and it's political risk and geopolitical risk. That's the one that's certainly here in the U.S. and then other places as we look around the world that is not sort of in that Goldilocks zone. There are plenty of risks, both from a conflict standpoint in places like the Middle East and both on the political front here at home that have a lot of market participants concerned. But this is the hard thing for markets to price. These events can move dramatically. They can move very quickly, and it's really difficult to sort of project how they'll impact portfolios, and certainly require sort of a different type of thinking. Because if you sort of set the politics and the intra-country relations aside, things look pretty good at the moment, and there's probably a little momentum still to go on sort of the positive economic run that we've been on. This chart sort of drives that point home a little bit. So this is a pretty good indicator of sort of where we see sort of overall concern in the U.S. economy. What we're looking at here is high yield bond spreads, and high yield bonds would be sort of the lower quality debt instruments in the market. So some of the riskier borrowers. And the level of the chart here just shows, how much more do these riskier borrowers have to pay to borrow money in the economy. And you can certainly see here, if you kind of rewind to that early COVID timeframe, when there's risks and when there's concerns about the ability of kind of smaller, lower quality companies to repay debt, the market reprices that very quickly. We saw that market move in the span of a couple days in the early phases of COVID. And as we look to the right-hand side of the chart, we're at a pretty low level, near sort of historic levels of tightness for high yield bond spreads, and pretty flat. So the market in sort of the way this instrument is priced would say not a whole lot of risk out there at the moment of sort of the ability of kind of the lower quality borrowers in the economy to repay debt. Something else we're thinking about as we look to markets and portfolios and returns. Certainly, U.S. equity returns have been really good over the last number of years, and it has been driven by a lot of things, but one that is sort of the primary driver is sort of the artificial intelligence revolution, or maybe the very early stages of a revolution. And as a result, we have seen a few companies here in the U.S., and they're names that you would all know: Apple, Facebook, Google, Tesla, Amazon, Nvidia. We've seen these companies perform at a historic level, and a lot of them are sort of in and around that sort of same trade on the early stages of artificial intelligence. And what the result has been sort of 7 to 10 companies in the US that are extremely large, and they have performed extremely well. But as a result, our market is now pretty concentrated. So if we think about the S&P 500, that's the 500 largest stocks within the US. The top 10 names within that index, when we think of that index, is very broadly diversified and representative of the overall economy. That index is that those top 10 names is now maybe 30 or 35% of the overall index, if not even a little bit higher today. So even though it appears to be a very broad and diversified index, and it is, the top 10 companies have become such a big piece of this index, and certainly a big driver of backward-looking returns and sort of a big determinant of forward-looking returns. We spend a lot of time thinking about the US. We're US-based investors. Our clients are all based in the US with obligations in the United States, but certainly we are firm believers in diversifying outside of just the United States. We recommend that just about all of our clients have exposure outside the US as well. The equity environment outside of the US has not been as good as it has been here at home. There are a number of reasons for it. One of them is certainly the effect of those large 10 companies. Those are US companies and not European. And then one of the others is that as the Fed had been raising rates dramatically over the last few years, the US dollar had sort of been getting stronger and stronger and stronger against a number of other currencies. If anyone's traveled abroad a few years ago, certainly they would have seen things be a little bit cheaper than maybe they would have been 10 years prior in Europe. That's starting to reverse itself a little bit. We've got the U.S. Central bank starting to lower rates. Other central banks around the world are maybe thinking of going the other way, like Japan did a couple months ago. And as a result, the dollar has started to weaken a little bit, and that could portend to some stronger returns for companies outside of the U.S. And just kind of one of those maybe highlights as we think about overall portfolio construction. And then so far, I've really just talked about the traditional sides of the market, U.S. equities and fixed income, international equities. We think about diversification meaning a lot more in our portfolios, something like commercial real estate. And when I said at the top of the meeting, just about every corner of the capital market has done well. This would be the one exception. Commercial real estate has gone through a repricing over the last couple of years as interest rates have gone up. And then also as the way we work as Americans has changed. I'm sitting in an office building in downtown Chicago today, but I wasn't yesterday, and I probably won't a few other days this week. And so the value of these office buildings has come down pretty dramatically, and that has caused somewhat of a crisis in commercial real estate. So we think we're probably sort of at the tail end of this cycle in commercial real estate, but just a good reminder that diversification sort of goes both ways, and that when everything else in the portfolio is working, here's an asset class that's maybe been struggling over the last couple of years. And then we also spend a lot of time thinking about the private markets. A lot of investments are certainly daily liquid and publicly traded, but the private markets, both private equity and private credit, have become a much bigger part of most portfolios, and that's true of the Community Foundation as well. And this asset class has not been immune to that rising rate environment over the last couple of years as well. Private equity activity slowed dramatically in sort of 2022 and 23. It appears to be picking up a little bit here in 24, a little bit more deal count and deal volume, but certainly interest rates at that higher level affects all corners of the capital markets, with private markets sort of not being excluded. So turning our attention just for a moment to the portfolio itself, we build long-term portfolios that are designed to sort of work throughout a number of market cycles. But just because they're long-term doesn't mean that they don't ever change. Certainly we reevaluate changes in the capital markets and how they affect portfolios on a regular basis. And one of the things we've done over the last year or two at the Community Foundation is add a little bit more fixed income into the portfolio. So if you look at that sort of bottom dark blue box, a couple years ago, fixed income was about as low as maybe we'd want it to go at around an 8% allocation. Today, that number is closer to 13. And that's just a realization that, hey, the world around us has changed. A couple years ago, you could buy a 10-year treasury bond and it gave you 1.5% or maybe 2%. Today, that number is closer to 4.5%. And so we'd say, hey, that's a much more useful instrument in the overall portfolio. And as a result, we think we can have a little bit more of it. And then lastly, performance. This is certainly a performance-based business. All the work we do with staff and committee all translates into the track record that you see here. It's one that we're pretty proud of. Pretty strong long-term results, both against a benchmark and then against a set of peers as we think about what other community foundations and other nonprofits are doing around the country. And this is important in that we know that donors have a lot of potential places to give their money, and working alongside the community foundation, we want everyone to know that a great place to put it is with Start Community Foundation. So proud of the track record that we've been able to establish here with the great help of the investment committee and staff. And I think with that, I will take a pause here and hand it over to Evan to talk through the political environment and how we think that's going to maybe change the work we do on a go-forward basis. So, all right. Evan, you're up to bat.
Thank you, Chris, and thank you, everyone, for joining today. We appreciate it. I'm not sure if anyone is aware, but we actually have an election coming up in a week. So we thought this topic would be a worthwhile one to go through. So without further ado, let's dive right in. So before we get into kind of the polling data and some of the impacts that this election may have on markets and the economy, we thought it might be helpful to just kind of take a look at the issues that typically drive elections and then look at how people feel about those issues today, because that might give us a sense of the way this election is going to go. Some of you may be familiar with that famous James Carville line, "It's the economy, stupid," right? Meaning that economic issues are typically most important for voters, and that's often the case. So there's some proof points to that. So the incumbent party has remained in control of the White House in 12 of the last 15 presidential elections, when the S&P 500 was positive during the 3 months before Election Day. And then on the flip side, when the index was lower in the 3 months preceding the election, the incumbent party lost 8 of 9 times. So certainly a strong indicator. But as we can see here, only about a third of voters feel like the economy is the most important issue facing the country right now, and that's below average. So it is possible that there are some other issues that are more important to voters this go around that could make this a more atypical election. So let's maybe explore what those issues might be. So here we go a little deeper and look at those other issues that are top of mind for voters right now. On the left, we have the more traditional kind of economic issues. Those are always going to be pertinent, right? So the economy in general is the most important issue for about 1/4 of voters right now. Inflation, of course, Chris talked about this a little bit earlier. Maybe more important for voters this cycle than in previous elections. About 15% of folks think that is the most important problem facing the U.S. today. And then other issues like taxes, wealth inequality, national debt, et cetera, further down the list. What's interesting, though, is how important the non-economic issues are for folks this year. So immigration, for instance, is the most important issue for about 22% of Americans. That's higher than normal. Political infighting, poor leadership, that's top of mind for about 17% of Americans, also higher than normal. And then things like, country unification, gun control, crime, those are also more important for voters than is usually the case. So we included this slide to kind of drive home the point that, while the economy is certainly still an important issue, non-economic issues may be more of a driving factor when it comes to the ultimate outcome of this election relative to elections in the past. So with all of that in mind, let's take a look at what the prediction markets are currently saying. So as you can see here, President Trump had the clear advantage to Vice President Harris when she wasn't running, of course. And then President Biden decided to drop out of the race in July. And since then, the race has narrowed, with Vice President Harris having seen a surge in August after replacing Biden at the top of the ticket. But her momentum has certainly waned in recent weeks. So this data is a little stale. It's about a week or two old. But right now, as of this moment, markets are assigning a 55% chance of former President Trump winning the election and a 45% chance of Vice President Harris winning. But it's obviously close. And most of the polling data that we're looking at right now is within the margin of error, particularly within the swing states that are going to ultimately decide the election. So, for instance, in Pennsylvania, former President Trump is leading in the polls by about 0.6%. In Wisconsin, Vice President Harris is leading by about 0.2%. In Michigan, Trump is leading by about 0.2%. So with about a week to go, The race is still a statistical dead heat with a lot that could frankly still happen between now and then. And then real quick for those curious, so obviously Ohio has been a swing state in years past. But former President Trump does maintain a lead of more than 7% in the polls in Ohio this year. So probably less of a toss-up, this year than in years past for Ohio. So that's the race for the White House. What about the race for Congress? Again, this data is a week or two old, but I think the story still applies here. When we have shown on the slide the chances rather of various outcomes as it relates to control of both the House and the Senate. So the red, as you can imagine, is both houses go Republican. Blue is both houses go Democrat. Orange, Republican House, Democratic Senate. Green, Democratic House, Republican Senate. And then a gray is a tie in one or both of those chambers. We can basically disregard the chances of Democrats winning both chambers, as well as the chance of a Republican House and a Democratic Senate. Those probabilities are very, very low. In all likelihood, we're going to have a split government with control of the Senate flipping to the Republicans and control of the House flipping to the Democrats. There is about a 25% or so chance we get Republican control of both chambers. But right now, it does look like we're going to get that divided government, which would ultimately make the passage of new legislation more difficult, regardless of who ends up winning the White House. So now that we've kind of set the stage in terms of what the voters are thinking and what the polls are showing, let's take a look at the potential impacts of new policies that we might see under a Trump or Harris administration on various market segments. We've kind of outlined the three biggest policy areas here, at least as they relate to markets. So trade, taxes, and regulation. So on trade, it's actually kind of interesting to note that both Republicans and Democrats have come out in favor of things like tariffs, trade restrictions, increased onshoring of supply chains. For instance, you've got bipartisan support to bring back the manufacturing of certain goods currently produced in India to the U.S., limit tech-related exports to China due to security concerns. And when it comes to taxes, more similarities across the two parties than maybe you would think. So both Republicans and Democrats want tax incentives to bring back technology manufacturing and energy production here in the U.S. One difference here is that Trump wants a tax reduction for the onshoring of pharmaceutical production, whereas Harris wants a tax increase there. And then finally on regulation, so the Inflation Reduction Act, that's sort of that key piece of legislation over the last couple of years, that likely isn't going anywhere, as you could argue that bill has ultimately helped red states more than it has blue states. So certainly the Democrats don't want to get rid of it because it's their key piece of legislation, but the Republicans might not want to get rid of it because it's helping their states as well. Regulation of big tech is also something that both parties agree needs to be kind of meted out in some way, as is regulation of pharma companies with the goal of bringing down drug prices. So I think the big takeaway from this slide is that while we hear a lot of boisterous rhetoric and name calling and all that stuff from both sides, the actual policy proposals, at least across these three broad economic areas, are actually surprisingly similar across the two parties. So here we get a bit more granular. I won't go through each of these boxes in great detail, and certainly Carrie can circulate this deck to anyone who's interested. But if we look at whether or not a Trump or Harris win is good, bad, or mixed for each sector or industry on the left, and here you can also see a lot of similarities. So for instance, we feel like both candidates would be positive for the defense industry, mixed for industries like auto and retail, and then negative for tech firms because of those proposed regulations that kind of the big differences that we see are really within spaces like energy and a Trump administration would likely be friendlier to big banks by relaxing and soft like lifting restrictions on drilling and liquid natural gas export, whereas Harris's policies would be more like a continuation of those restrictions and an emphasis on clean energy that would benefit renewables-focused companies. But I do want everyone to kind of remember that idea, the idea that Trump would benefit traditional energy, Harris would benefit clean energy, because we're going to revisit that later on in the presentation when we talk about the pitfalls of market timing around elections.
Hey, Evan, looks like you might be having some bandwidth issues. Maybe drop the video and we just hear your beautiful voice.
I've got a face for radio, so that shouldn't be a problem for anyone involved. How does that sound, Chris? Is that all right?
Yeah, I think that's a little clearer for the moment.
Okay, apologies for that. So now we can, that's kind of the broad view on sectors. Let's take a look at how the candidates might influence different macroeconomic variables. So we'll start with a potential Trump presidency. And keep in mind that these are incremental, but it does seem as though Trump's proposed tax cuts would run the economy somewhat hot compared to what it is now. Pushing 2028 GDP up about 0.3% relative to the pre-election baseline and adding about 0.4% to inflation, whereas Harris's more cautious approach would likely leave pre-election forecasts little changed, as you can see by the blue bars there. Okay, so let's take a look at the national debt, obviously top of mind for a lot of folks. So just by way of background, this year the US is expected to run a fiscal deficit of around 6.5%, and its debt to GDP ratio will approach 100%, up from about 80% just 5 years ago. And so against that backdrop, it is a bit striking that Trump's tax policies would significantly add to the debt burden, whereas Harris's wouldn't do a whole lot to reduce it. So kind of to that point, models are showing that Trump's income tax cuts, lowering the corporate tax rate, they would lift the national debt to about 115% of GDP over the next 4 years. And you can see that debt burden increases as we look further out into the future. Harris's plans for things like child tax credits, home buyer support, higher corporate taxes would raise debt to about 110% of GDP in 2028, which is in line with the CBO baseline forecast at that point. But then were those policies to persist into the future, the debt arising from the Harris policies would actually exceed that baseline figure within the next 10 years. So it's important to remember that when we shift focus from kind of the promises that we hear on the campaign trail to what's actually deliverable with the divided Congress that we talked about earlier, those differences between the trajectories narrow. But regardless, national debt is still a major issue that it seems right now that neither candidate is willing to address that on. So let's look at trade, obviously a hot button issue given an increase in protectionism over the last decade or so. Anyone who was here last year, I believe we did a presentation on deglobalization. You can see that kind of in the blue bar here. So that's the share of US imports coming from China, rising throughout the 90s and 2000s, peaking at around 21%, and then falling after Trump took office and implemented his tariff program. So now about 14% of US imports are from China. And if the current tariffs remain in place, which is something that Democrats have been at least receptive to, we expect that number to fall to around 9% in the next 4 years. If Trump is ultimately elected and he slaps a 60% or more tariff on China and then another 20 on all other imports, imports from China would become negligible. Now, again, it's not clear whether that 60% figure is serious or more of a negotiating tactic, but it is possible that a second Trump administration could change the face of international trade as we know it. So what is the impact of a potentially escalating trade war on economic growth and price levels? So put simply, Trump's new tariffs, they would lower growth and increase inflation. It's just a question of by how much. So based on models from the World Trade Organization, the maximal Trump tariff plan would wipe about 0.8% from GDP and push prices up by about 4.3% in the next 4 years. If China alone retaliates and hits the US with trade restrictions of their own, if other countries hit back as well, those numbers go to negative 1.3% for GDP and 0.5% for prices. So again, we don't know how much of that tariff hike would be eaten by retailers instead of consumers. We don't know how much a potential appreciation in the dollar would offset the inflationary impact of a potential trade war. But clearly, a blow to U.S. exports takes significant heat out of the economy and would cause a meaningful uptick in inflation. So finally, let's look at GDP growth and inflation through the lens of immigration. We've obviously heard a lot about former President Trump on this topic. So these are forecasts from Bloomberg. We included these more as a thought experiment. I don't think anyone really expects the mass deportation of all unauthorized immigrants in this country to take place in the next 4 years. There's actually a very interesting 60 Minutes piece from this most recent Sunday that kind of walked through what that way might look like. I encourage you all to watch that if you haven't already. But it may be helpful for us to kind of get a sense directionality of how fewer immigrants or even a reduction in the number of immigrants currently in the US would impact these two variables. And it's pretty clear. So fewer workers means lower GDP. So in the scenario where only recent arrivals are deported, the economy would be more than 3% smaller by 2028 relative to a baseline of no policy change. And since GDP would fall faster than the population, incomes would shrink as well. And then as for inflation, so in industries that are highly dependent on migrant labor, places like hospitality, manufacturing, construction, we could see increases in wages and prices. But in aggregate, though, with deportations hitting demand as well as supply, the combined effect is ultimately deflationary in nature. So the upshot here is performance, right? What do all these potential policy changes mean for the performance of equity markets specifically? And obviously it's impossible to say, but we did look through history to kind of give us some sense of what we might expect going forward. So first we took a look at how the S&P performed in each of the last dozen or so presidential election years. And what we can see here is that the index has been positive in all of those instances except for two, so 2000 and 2008. And I think most of us will be able to remember that the negative performance during those years, it was less about presidential politics and more about the economic landscape. So for instance, in 2000, we had the bursting of the tech bubble. And then in 2008, we had the global financial crisis. So we included this slide to kind of make the point that markets are generally positive during presidential election years, regardless of who ultimately ends up winning. And when they are negative, it's less about the politics and more about the economic environment. And then maybe one other slide to kind of drive that point home. So we looked at the average cumulative return of the S&P 500 over each of the four different political years going back to the 1950s. So year one in green, that's the year before the midterms. Year two, light blue, that's the midterm election year. Year three in purple is the year before the presidential election. And then year four is the dark blue, that's the presidential election year. So a couple of interesting things to point out here. First, although there is some choppiness along the way, the S&P is on average positive in each of these years. But perhaps what's more interesting or relevant for this particular discussion is performance of the index in the months following the election cycle. So you can see those little kinks upward in each of the lines around the November-December timeframe, meaning performance for the S&P tends to be higher than average during those months. The idea here is that markets like certainty, investors like being able to forecast policy more accurately and get a sense of which areas of the market might work well in the future. But I think before anyone starts making portfolio allocation decisions around this election or any other election, let's take a look at the case study that I alluded to earlier that outlines kind of the pitfalls of trying to time the market. We're going to tie it back to that slide on the pros and cons for the sectors. So let's take energy. We have traditional energy. So, think oil and gas companies, E&P companies, et cetera, kind of those old school businesses. And then clean energy. So think companies tied to the renewable revolution, renewable sources of fuel, green energy companies, kind of those new school businesses. I think we'd all agree that the Trump administration would be better for traditional energy companies and that Biden, in this case, administration would have been better for clean energy companies. But performance of those sectors during each of those presidencies tells a bit of a different story. So under Trump, the traditional energy index was down 30% on a cumulative basis, and the clean energy index was up about 300%. And on the flip side, under the Biden administration, the traditional energy index is up around 160%, again, cumulative, and the clean energy index is down 50%. So you might be asking yourself, all right, well, what the heck is going on here? A couple of factors help explain this trend. So first, markets tend to be forward-looking in nature. They reflect investor expectations of what's to come in the sometimes distant future. Second, perhaps most importantly, so you've got exogenous shocks that can disrupt markets and lead to maybe more unexpected dynamics. So for instance, everyone remembers the pandemic kind of upending supply chains. You had the invasion of Ukraine in, I believe, early 2022. Those things led to the increases in the prices of a lot of commodities. Those events were very conducive to positive performance for more traditional energy companies, despite a renewables focus U.S. president. And then, finally, there's just the question of kind of natural business and economic cycles, which have tended to ebb and flow regardless of which party kind of controls the White House. So all of this is to say that market timing around an election or anything else as well can be somewhat of a difficult exercise. Okay, so if you remember any slide or any visual from this presentation, I would encourage you to make it this one. And it's pretty simple, right? So here we show the growth of $1,000 invested in the S&P back in the early 50s. And the takeaway is pretty straightforward. So equity markets trend up regardless of who controls the White House. And Chris and I were talking about, poor President Bush, right? George W. Bush. He got in right at the peak of the tech bubble and then got out right when the GFC was unfurling. So he maybe got a little unlucky. But the tendency here is for markets to trend up. And while it's important to understand the ramifications of things like new tax policy, new trade policy, new regulations at both the micro and macro levels, ultimately, the broad market is more concerned with things like company earnings growth, the health of the consumer, central bank policy, et cetera, than what's going on in Washington, D.C. So kind of given these dynamics, Marquette certainly advocates not for tactically positioning portfolios based on what we might, what we think might happen with this or any other election, but rather adhering to a strategic asset allocation policy that emphasizes diversification at a long-term time horizon. So Carrie, maybe I'll turn it back over to you. I do apologize again for my audio issues. Hopefully that came in relatively loud and clear for folks. Carrie, I know you've got some questions for us, and happy to take those at this time.
Yeah, thanks, Evan. Yeah, a little hiccup there, but it ended up just fine. So thank you for that. And Chris and Evan, thank you very much. As I mentioned previously, Marquette's been our consultants from 2019 to today, and we've been very pleased. And we're not going to let you out of here today without at least a couple questions, though. I do want to address, some people were asking if we can get the slide deck out. Yes, the session's being recorded and the slide deck is available, and it will be emailed to all participants. So you'll be able to get your hands on all of that. But maybe just a couple follow-up questions. And Chris and Evan, I'll let you decide who's best to respond to these. But you talked about, the Fed and the rate cuts, and I know the 50 basis points was probably a little higher than markets were expecting, but it does seem that the 10-year Treasury yields have certainly gone up since then. Are we about out of this inverted yield curve? Because I know there's been so much discussion around that, and that being like the biggest indicator of a recession, which we know never happened. So what's your thoughts on that?
Yeah, so on the inverted yield curve for a minute, there's a bunch of different ways to measure it, but the typical version is the 2-year Treasury bond and the 10-year Treasury. That's been sort of that predictor of a recessionary environment. That was inverted for, I think it was like 750 days, more than a 2-year period. And historically, that was one of the indicators that really was rock solid of a pending recession. When you saw that yield curve invert, where 2-year bonds yield more than 10-year bonds, that usually meant a recession's coming. And that's sort of an unnatural state of an interest rate environment, right? Like usually the longer you loan money to somebody, the more you would expect an interest, not the opposite. That didn't happen this time around. Certainly someday a recession will come, and you might say, well, the yield curve inverted, but that sort of predictive power is probably gone. If it's not predictive inside of a 2-year period, it's probably gone. And I think the reason for it is that we had interest rates so low for so long that companies and consumers locked in as much sort of low-cost debt as they could. There are a lot of 30-year mortgages out there that are maybe 5 or 6 years in with an interest rate around 3%. So you think about on the consumer front, one of the biggest probably debt loads in most households would be the cost of a home, and that debt was fixed at a really low level. So raising rates did not affect consumers in the way that it used to, and the same thing for companies. I think in the S&P 500, something like 90% of their debt was fixed, sort of heading into that rising rate environment. And even there was a report about Google a few weeks ago that Google was actually earning more on their short-term cash than their debt was costing them. So raising rates for a company like Google was a positive. They were making more money off of it. That's not normal. That's normally what doesn't happen. Yeah. So I think that's the reason why that sort of inverted yield curve predictor was not as useful this time around. It has since flipped back. So to your point before, the Fed cut rates by 50 basis points, and we all sort of get in the mindset of lower interest rates. But a lot of that had been sort of expected ahead of time. The 10-year Treasury bond had been trending sort of lower and lower and lower up into that moment. And since that point in time, the 10-year Treasury has gone up like 50 or 60 basis points. So today it's closer to 4.3%. It was around 3.5 when the Fed cut rates. And the 2 years right around 4 and 4.15. So we've got a more normal upward sloping yield curve, with the exception of the very short end. Short-term rates overnight, kind of 1 month, 3 month T-bills are still yielding 4.5 or higher. But as the Fed probably continues to normalize policy, we would expect sort of the whole yield curve to be upward sloping here relatively soon. But that sort of all important 210 measure is back to a more normal, it's relatively flat, but a more normal upward slope.
Okay. And you mentioned, we talked about the rate cuts. It's interesting, and maybe a comment, maybe a question here. I know the slide showed probably the market's anticipating 2 rate cuts. I think for the first time I heard, I think it was BlackRock came out and said, nope, it's probably going to be 1. So I don't know if you guys have any thoughts there.
Yeah, and so the Fed's been pretty clear that they're going to try to be data dependent, and they're going to make these decisions. They're not going to have a sort of prescribed method, but they're going to wait and see as this data comes out. The next meeting for them, they've got 2 more this year. There's one after the election in kind of middle of November, and then one in December. And so kind of a month or so ago, the expectation was for 2 cuts, 1 at each meeting for 1/4 of a point. So we'd be at a Fed funds rate around 4.25 by the end of the year. Some of that expectation has come out a little bit. You've seen a few. I think you said BlackRock was one. A few others have sort of said, "Hey, maybe we only get 1 cut this year. It's possible we don't get any." And the reason for it is the last few data releases, the big ones, inflation and unemployment, have come in pretty decent. The inflation one was probably a little hotter than the Fed wanted to see. And then the last jobs report, unemployment went from 4.3 back to 4.1. So I think there's probably not a great case to be made that we should be dramatically lowering interest rates and stimulating the economy, because the economy still seems to be moving along okay. Yeah. You've got pretty decent price momentum. For the most part, people are out and people are working. So there's not a real great case to say, hey, we need to take rates from 4.75 to 3.5 like now. So it's certainly possible that time frame gets even extended out further. The likely path is down, but then there's the question of, well, when? And certainly it seems like there's momentum that those cuts may come further into the future than we were expecting.
Because the biggest fear is if they cut too quick, then the inflation goes right back up.
Yeah, I mean, that's probably the worst case scenario for a central banker. And that if they cut interest rates too fast and we see inflation go back to 3.5 or 4, and they have to think about raising rates again, then it looks like they made multiple policy errors in a pretty short period of time. So I think they would be sort of happy to see things sort of level out a little bit. And what they don't want to see is unemployment lift dramatically either. If you saw unemployment go from 4.1 to 4.5 to 5 pretty quick, then they would accelerate that. But we're not seeing it. There was a little bit of weakness in the labor market towards the end of the summer, and then the last release looked pretty good.
Very good, Chris. Thank you. Maybe to pivot a little bit, I don't know if you guys have any thoughts. I know another big headline right now is the oil prices have really started to tumble. I know I got excited for, I think it was like a day, maybe 2, that gas was down to $2.59, and then I come out the next day and it's back up to $3.20. So I don't know if either you or Evan have any thoughts or insights in the oil prices and what we're seeing most recently.
Yeah, I'll let Evan answer that, but I'll just intro it by saying, certainly there's a lot of momentum towards kind of that clean energy transition, but oil is still a pretty useful commodity throughout the economy and is likely going to be that way for a while. And we certainly look to that for signals. So Evan, what are your thoughts on that one?
Yeah, we've been getting this question a lot actually at client meetings. So last I checked, which I think was a week or so ago, crude specifically trades at about $73, $74 a barrel. That does seem kind of, to your point, Carrie, low given tensions in the Middle East that have been certainly escalating over the last year. I think big reason for the challenges that oil has faced in recent time are more due to the demand side. So people have talked a lot about the health of China's economy, for instance. They're, I believe, the world's top oil importer, but given weaknesses in their economy, they've had to dial back their refinery output in recent months. Plus, kind of to Chris's point, they've been at the forefront of the EV electric vehicle revolution. So that's going to impact demand as well. A couple other things. So Israel's come out and said that if they're going to engage with Iran, they're only going to strike military targets, not oil facilities. That's keeping prices down. And then finally, OPEC is said to have extra production capacity. So I think you take all of these factors in tandem. They're working to keep oil prices down. Now, that being said, should we get a flare up in kind of those conflicts in the Middle East, or we see demand start to normalize, particularly in China, we could get higher oil and just general commodity prices in the near term.
And that's another one of those signals that's sort of in that Goldilocks zone, right? Like it's not, flashing really dramatic one way or the other. It's sort of in a normal kind of range bound area. So that's another one of those things we lump into, it's sort of a benign scenario right now, despite, again, a ton of challenges in parts of the world that could very quickly change that scenario.
Maybe we got 1 minute for one last question here. And I think, Chris, you touched on this a little bit, the whole S&P and the concentration by the top 10 companies. And we hear so much about the Magnificent Seven. But do you see that starting to broaden out at all? You're hearing a lot about company earnings coming in pretty good. Or is that going to continue to really dominate the top 7, 10?
Yeah, it's been kind of fits and starts. So, what you'd want to see if you were sort of drawing up a good case for a bull market is really good market breadth. It's probably not real healthy for in any given month, if the market's up 5 percentage points, it's not real healthy for most of that return to come from 10 names or 7 names or 5 names. You'd want to see more breadth. You'd want to see more sectors participate and want to see more companies in the sectors participate. There have been points in time kind of throughout the last 12 to 18 months where for a minute, it looks like we see a lot more breadth in the market. And in July was a good example. In the month of July, for about a 2-week period, small cap stocks were up like 10%. And I think, NVIDIA, one of the leaders in the Mag 7, was down off of some earnings reports. So it was like, all right, hey, we're finally getting that moment where other companies are participating. But we haven't been able to sort of sustain that. So I would expect we're going to be in this environment for a while still. And because there's such a big part of the index, to some extent, the way they go is definitely going to impact overall market returns. You'd like to think that if they start to trip up a little bit, some of the other companies and other sectors can pick up the slack. And that's possible. And that's probably what you'd want to see or expect to see if we really are in as good of an economy as we think. But they're going to just be such a big dominant piece of headlines and returns going forward for a while because they're massive companies and they touch everything that we do. I mean, you probably can all look around you to wherever you are at the moment and see a product from one of them in your near lines of sight, and you'll interact with 10 more throughout the day. So they're everywhere and they're huge and they make a ton of money.
And maybe if I could just add something to that and maybe put in a plug for the research that we do. So we actually put out a piece yesterday on earnings growth for the Mag 7 and for the rest of the S&P. You can find it. It's fresh off the presses, released yesterday on our website. And basically what we show is that, through 23 into 24, Mag 7 companies were growing earnings at more than 50% year over year, just an astronomically high number versus the S&P, which is growing earnings at like 7 or 8% during those periods. But then we also have the forecast for, again, both Mag 7 earnings growth and S&P earnings growth over the next, call it year and a half. And what we see is significant moderation. So while we still expect the Mag 7 companies to grow earnings at a faster rate than the S&P, the delta between those two we expect to be much more narrow going forward. So I agree with Chris's point. They're going to certainly drive returns for broad-based indices, just given how big they are, how big of the economy they touch, and the weight they make up in the index, which I think is like 32%. But given kind of that trend toward more moderate earnings growth, at least relative to the rest of the market, hopefully we do get some broadening out here in the near future.
Okay. Well, Chris, Evan, we thank you. We're very close to 10 o'clock, so I think we're going to wrap it up. So again, thank you for the presentation today, and really to all of our participants, no matter what your relationship is with the foundation, we want to thank you as well and let you all know we appreciate you. And with that, we're going to close it and just tell everybody have a great day. And as a reminder, we will be emailing out the recording and the slide deck. So thanks, everyone. Have a good day.